the Canadian Foundation for Economic Education, and I am also the program coordinator for the Help Managing Your Money on Campus program. So the Canadian Foundation for Economic Education, or as we call it, CFE, is pleased to partner with post-secondary schools across the country to help students get a better handle on their money. Today's topic is how to manage debt and credit. So we're going to cover some very important information that you'll be able to put to action right away to help improve your credit score or start to establish a credit score to help you in the future. So the workshop itself is going to last about an hour, and then we will have time for a Q&A for about 30 minutes at the end of the presentation if you have any questions about any of the material that we're talking about today. So I have sent the pre-survey in the chat. I'm going to do that again. If you complete both the pre and post survey for this workshop, you'll be entered into a draw to win one of 4 $50 Tim Hortons gift cards. So the program Help Managing Your Money on Campus is designed to help support young students by providing comprehensive financial education modules. This is so important and timely because more than ever, we live in a complex financial world. Whether you've already experienced the world of financial costs, responsibilities, planning, spending, debt, credit cards, or if it's all new to you, we're here to help. And that's exactly why we've partnered with universities and colleges across the country to help equip students with the information they need to take on all of life's financial challenges. So the first half of 2020, we asked students about their priorities and what they want to learn more about. Nearly 1,500 students answered our survey from 94 different post-secondary institutions, and this is what we learned. 48% of students said they have difficulty generally knowing how to manage their finances. 64% want to learn how to deal with financial stress, and 55% want to build a financially healthy life. So that's why I put together today's workshop about managing debt and credit. Debt and credit are a very important part of a well-balanced financial portfolio, but they can also be things that, if we don't deal with them appropriately, can lead to that financial stress, and it can cause more harm than good. So we need to make sure that we're taking the right steps to use them effectively and put them to work for us so that we're taking advantage of what they offer rather than dealing with or suffering from the consequences of not managing it appropriately and not taking it seriously. So what are we talking about today? We are going to look at how to manage your debt. Not all debt is bad, and we're going to explain the differences between good and bad debt. We also want to make sure you understand all of the terms of debt and borrowing before you sign on the dotted line. Then we're going to look at using credit cards. These can be a great tool to use, but you have to understand the consequences and how punitive it can be if you don't pay off your balance and if you don't take those credit cards seriously, if you try and use it like extra play money. Lastly, we'll discuss the impacts and how you can improve your credit score and the importance of credit reports. So that's what we're going to actually talk about. Here are our learning objectives. So if you're going to learn 3 things out of today, I want it to be an understanding of how credit cards work. I want you to dedicate to paying off your credit card balance monthly and understand and take steps to improve your credit score. So the first topic, as I mentioned, how to manage your debt. So we're going to look at the word debt, some different types of debt, and ways to lower your outstanding debt. So what do you think of when you hear the word debt? Debt can mean a lot of different things to a lot of different people depending on your life experiences. Some people think of it as being a negative, right? They've got words like liability, bad, debt spiral, interest, right? It's the negative consequences that come out of taking on debt or taking on too much debt. But some other people may have a more positive view on debt, right? Debt can allow us to get things like a mortgage, maybe a car loan. These are things that we wouldn't be able to pay out of pocket for without significant time spent saving up for them. And so debt gives us the ability to access these type of things. Can also sometimes, lead to the benefits, right? If we have a credit card that has different reward systems with it, maybe it can allow us to go on a trip using points or pay for groceries using points, things like that. So debt's going to mean something different to everybody. But it's important to make sure that you think a little bit about what debt means to you so that you understand going in, if you have a very negative view on debt, then maybe you need to try and figure out what the potential benefits are to it so that you understand the importance of taking advantage of it and using it effectively. And if you have an overly positive view of debt, then it might be worth understanding what the consequences are of debt so that you're not overextending yourself into a situation where now you're suffering because of it, right? Try and learn about the consequences before getting into a situation where they're now affecting you. There are many different types of debt. Some examples: student loans, credit cards, overdraft protection, personal loans, mortgages, leases, home equity loans. Student loans, if you're looking at going into post-secondary education, are something you are likely going to become familiar with. The majority of students end up taking on some form of student loan, usually government student loans, in order to help pay for your education. These are very specific loans and can have some great benefits for you, including obviously helping you get that education that you might not be able to afford otherwise. Credit cards are a type of revolving credit from a financial institution. You're given a maximum available credit usage and can charge purchases to the card and draw from that total. Interest is charged on the portion used, not on the available credit. So if you only have a certain percentage of your card outstanding, say you only have $300 outstanding, but your limit's $1,000, you're not being charged interest on $1,000. You're going to be charged interest on what you've used. Mortgages are special long-term, large loans given in order to acquire a property. They usually require a cash down payment to secure that mortgage. And then home equity loans. These are secured loans where you borrow against the value of your home. So as you make mortgage payments, a portion of each of these goes towards covering the principal of your mortgage, which builds up equity in the property. A home equity loan allows you to use this built up equity as collateral for a loan. Since part of your home is used as collateral, the consequences of not making payments can be as serious as with a standard mortgage. So let's look at a quick video about the differences between good and bad debt.
Welcome to the Wonga Money Academy. In this episode, we look at debt, one of the 4 pillars of financial literacy. Fortunately, it isn't difficult to understand. Debt is simply money you've borrowed and have to pay back later, and most people will have debt at some point in their lives. Think carefully before putting yourself in this position, as the amount of money you pay back is always more than what you borrow. This is because credit providers offer a service that comes with a fee. They work out the fee by adding a percentage of what you borrow to your monthly installments, and it's called interest. There's also a difference between taking on good debt compared to bad debt. Borrowing money to pay for things you don't need counts as bad debt. Expensive clothes, the latest electronics, or pricey holidays, once they're worn out, burnt out, or over, you'll have nothing to show for them. Take buying a brand new car, for example. It will definitely lose its value and perhaps put you in a tough spot as well. What if you lost your job and couldn't keep up with the repayments? You might end up with a loan that's greater than the amount you could sell the car for. That would leave you with no car, plus an outstanding debt to pay. Credit card debt is always bad because the interest rates are a lot higher, usually in the double digits. In many cases, if you can only make the minimum payments, it will take you years to pay it off. Good debt applies to things like taking on a student loan for an education. In the long run, it will help you earn a higher salary, so essentially, you'll be accepting debt to get ahead in life. Taking out a home loan can also be a good debt situation. Once it's paid off, your home will be a big financial asset. The interest rates are also low compared to other credit providers. That's all on debt for now, but we'll be coming back to it later on in the series.
Okay, so as a brief summary about good debt versus bad debt, in general, good debt is something that adds value to your life. It helps you earn money. It helps you increase your personal wealth, your personal value. Where bad debt is going to be that consumer debt. It's the things that you're buying on credit, and by the time you go to pay for it, you've already used it. Whether it's going on a vacation, whether it's uh, going to a restaurant to eat out, things like that. Those are not necessarily things that you can't do, but you want to make sure that you're using money that you have to do them, not putting them on a credit card without having the funds to pay it off. So that's what we talk about when we talk about taking on debt. It doesn't mean that you can't put it on a credit card, but you want to make sure that you have the money to pay off that credit card when you do that, and that you pay that card rather than holding it as a balance or making a purchase above and beyond the money that you have available. So some questions to ask yourself before borrowing money to make sure that you're not getting in over your head when it comes to your borrowing. So first, how much are you able to repay each month? First, you have to make sure that you can afford the loan and its monthly payment. It's important you do not make financial commitments you cannot afford. Do your research before applying for a loan. You want to make sure that you can understand how much it's going to cost you each month and how much you can afford to pay, right? If you're looking at a car and all of the cars available are $500 a month, you might find one that's $400 a month. And yes, that's cheaper. But if all you can afford is $200 a month, it's still not in your price range. So you need to make sure you understand what you're capable of paying before you worry about what the prices are. Next, what's the total amount that you will need to actually repay? It's important to calculate the accumulating interest on top of the loan within your payment schedule. Interest rates vary depending on the type of loan. For example, if you take out a $10,000 loan, the first year the interest at 5% compounded annually would be $500 for a total of $10,500. If no payments are made, the following year it becomes 5% interest on that $10,500 for a total of $1,000 or $1,025 in interest on that total $10,000 loan. So cumulative $1,025 or $525 in year two. So as you don't make payments, that interest adds up. So how much is it going to cost you, especially if it's a long-term loan like a mortgage or like a car loan? What is that total interest amount going to be? Is the loan secured? What does a secure loan mean? A secured loan means if you do not repay the loan, the creditor has legal claim of your assets. This could be a house or a car or something else like that that's been set up as collateral. This is based on the terms of your contract. Your interest rate on a secured loan is usually lower as the financial institution can take something of value from you if you are unable to make payments. But beware, you don't want to lose your car or your house to the bank. You can also get things like a secured credit card where you put money into a savings account and you'll get a credit card with the balance of those funds. And then if you don't pay off your card, they're able to close your card and take the money out of the account. How long is it going to take to repay the loan? Always reference the term of the loan in the contract. So a good rule of thumb is the longer the term, the more interest you will have to pay. So the PMT function in Excel can help you understand how the term, interest rate, and number of payments can affect how much you actually end up paying each month. The longer the term, the more interest you're going to have to pay. If I miss a payment, will the interest rate change? This is going to depend entirely on the type of loan you have. An interest rate may increase if you fail to pay by the due date. This is something you want to know ahead of time so that you can understand when you're calculating how much interest you will pay over that time frame. You want to know if that interest rate is going to change to make sure that you have the correct calculation. Does my loan have insurance? Loan insurance may be an option depending on your creditor. By paying into loan insurance, it is possible for the creditor to pay your monthly payment for you if you are unable to work or have become ill. This form of insurance is typically more expensive than standalone term life insurance or disability insurance. So shop around for the lowest cost if you want to pursue this angle. You may get a lower interest rate on the loan if you buy this insurance, as it protects the lender in case you die or can't work. So make sure you weigh all the costs. In general, we recommend doing your research into those term life and disability insurance options because they will often serve the same purpose as specific loan insurance, but will provide other benefits as well at a comparable price. So here are some tips to help make paying off your loan a little bit easier. First, consider creating a payment schedule so you're able to keep track of your payments as you go. You can set up these schedules in Excel, and this will help you break down. You can see here we've got our first payment of $1,297. We know how much of it is paying interest, how much is paying principal, and how much we still owe. Once we make that first payment, we can go to the second one and we can visually keep track of the progress we're making on paying off our loan, rather than it being just a big abstract that eventually we're going to get there maybe. By being able to physically see the progress you're making can help keep you on track. Pay more than the minimum amount each month if you can. This will compound the amount of interest building on the initial principal. If you're paying 20% interest on a credit card, this will greatly increase the cost of whatever you purchased if you only pay that minimum amount. If you're paid bi-weekly, you may decide to make payments every 2 weeks. This can reduce the pressure off your paycheck at the end of the month. And it's also versus regular monthly payments, it can be a way to pay an extra month, which means you can actually pay off that loan quicker. As an example, if you're supposed to pay $1,000 per month, but instead pay $500 every 2 weeks on the day that you get paid, then you will pay $13,000 a year versus $12,000 a year if you only paid $1,000 a month or $500 twice a month. This is an extra $1,000 per year that'll help pay down the principal of the loan more quickly. Now we have ourselves a Zoom poll. What is one thing that you've taken away about how to manage your debt? I'm going to pull that up quickly and we'll see what you think. Something about how to manage debt. Was it about knowing when to borrow, the differences between good and bad debt, knowing how much to borrow, or loan security? I'm going to end the poll. Looks like the big winner is the difference between good and bad debt. Great. That is a very important one to know the difference of, because it can really help with a lot of those decision-making purposes, right? Is this a good reason to take on debt? Is it a type of good debt, or is it a type of bad debt? Now, what do you do if you have too much debt? So there are two typical approaches to paying down debt if you have too much. The snowball approach is to start small and build up to your larger debts. So if you owe $50 person X, $100 to person Y, and $300 to person Z, you pay off the $50 to X first, while paying at least the minimum payments on the other two loans. Then you celebrate that success and then use that confidence to pay down the $100 and then the $300. You start with that small debt, you get it paid off quickly, and then you can move on to the other types of debt. The avalanche method is an approach where you look at the debts you have to pay, and the one that is the most painful is what you pay first. So if the interest rate on the first person, the $50, is 5%, the interest rate on the $100 to person Y is 20%, and the $300 to person Z is at 10%, you'd end up paying off person Y. That $100 would get paid off first because the interest is so much higher than the others. That way, the interest you owe, what's making it hard to get out of debt, is going to drop quicker than with the other approaches. In general, the avalanche method is going to be the way that gets you out of debt fastest, right? You get the higher interest paid off first, so you end up having to pay less overall. But there can be a lot of benefit to the snowball method, having those success points, knowing that you've paid that one off, and now you can move on to the next one, you get it paid off. Whereas the avalanche method can take a bit longer to get any success points. At the end of the day, the method that gets you out of debt is the best one, right? Trying the avalanche method, doing the avalanche method, and not following through with it because it feels too overwhelming, that avalanche method is not better for you, right? If the snowball method is going to actually help you get out of debt, that's the better approach. Go with whatever is going to actually help you. So that is section 1. So we looked at how there are many different forms and features of debt. So make sure before you sign a contract and borrow money, read what you're going to sign so that you understand, is there loan security? Like, is the loan secured? Is there collateral? Is loan insurance an option if that's something I'm interested in? How much is it going to cost me? There can be good forms of debt, like paying for your education, buying a house, and maybe buying a car if it can help you get to work and earn money. And there are a couple of different ways to lower debt, so make sure that you pay attention to the approach that's going to work to help you get out of debt. Now we're going to look at using credit cards. So let's watch a video about credit cards and credit card interest.
Are you wondering how a credit card works? I'll explain in less time than it takes to put together a puzzle. Where's the lid with the picture on it? I'll explain in less time than it takes to put together a puzzle without the lid with the picture on it. Oh, come on. A credit card is a payment tool that allows you, for example, to buy stuff online. The card issuer gives you a credit limit and you pay it off later. You can also use it as a cash advance. That's a cash withdrawal made from your credit card. It can be really practical in some instances. Interest on cash advances is higher than on purchases, and it starts being calculated as soon as you make a withdrawal. Every month, your bank will send you a statement, including your credit card balance, minimum payment amount, and a due date. From the moment the statement is issued, you have 21 days to pay off your card. If you pay off your card in full by the due date, you won't have to pay any interest on your purchases. However, if you don't pay off the full balance by the due date, the interest will start to accumulate and will be calculated from the date you made your purchase. Calculating interest can kind of be like putting together a puzzle. A puzzle without the lid with the picture on it? But it's not that complicated. The interest rate for the things you put on your card is annual. The rate depends on which card you pick. Interest is calculated based on the amount you still owe. For example, say you owe $100 on your credit card and pay $15. Until you actually pay the $15, interest will be calculated on the full $100. After that, interest will be calculated on the remaining $85 until you pay off the card in full. If you choose not to pay off your card balance in full, the most important thing to do is make sure you pay at least the minimum amount owed by the due date. If you manage your credit well, you'll help build your credit report, which will influence your credit rating. This will come in handy when you're trying to sign the lease on a new apartment or buy a new car. Some cards offer other benefits like cashback, rewards, or purchase protection. See, credit cards can be useful. Oh, there you go. It's a credit card.
Okay. So let's look at some terminology for credit cards. First, annual fee. So the annual fee, this is how much the credit card charges you every year. If you have an annual fee on your credit card or a significant annual fee, maybe give your credit card company a call and see if they'll waive it for you. This is not guaranteed, but they may be willing to waive that fee in order to keep you as a customer. They're more likely, or they're often more concerned with making money off of interest than they are with those annual fees. They're just there to bring in a little bit extra. Your balance due, this is what you owe, what is currently outstanding and outpaid on your credit card. So as I mentioned, credit cards are a revolving type of credit. So you'll have a total credit limit, which is the total amount you can borrow. And your balance due is how much of that is currently outstanding. Finance charges, if you don't pay your bill on time, these charges can include things like late fees and interest. You'll likely pay a higher rate of interest on any cash you borrow using your card and a lower rate on money you borrow for purchases. Your credit card company treats these as two different kinds of balances that they charge at different rates. The grace period is the time you have to pay off your balance each month before you have to actually pay that interest. So by law in Canada, the lender must give you at least 21 days on your purchases before they can charge you interest. Your APR, the annual percentage rate. So this is the actual annual rate that you are being charged on your card. It is going to be applied more often than once a year, but the annual percentage rate tells you what that annual rate is, the annualized rate. The introductory rate could be a special offer rate that you're given when you first sign up for the card. So make sure when you are going to sign up for a card, you ask them, is this an introductory rate or is this the APR? So you understand if they're saying, interest is only 5%, and then after 6 months, interest goes up to 30%, maybe it's not as good of a deal as you thought it was. And minimum monthly payment is how much you're required to pay each month before you get some additional charges put on. Minimum monthly payment does not prevent them from charging interest. It just stops them from missing a payment. That's the smallest amount that you can make without getting in trouble. Okay, we're going to look at here we go, credit card comparison tool. So this is from the Government of Canada that can help with your credit card selection process. So you can select your province. I'm in Ontario. I'm looking to use Canadian currency. Am I looking for a card with low purchase interest? I'm going to say no for now, but if you anticipate carrying a balance each month, if you know you're likely not going to be able to pay off your card in full every month, then you might want to look at a card with low purchase interest. If you're planning on having your card paid off, then it's not necessarily beneficial. There's likely other rewards you could get that are going to serve you better than that lower interest rate. So I'm going to hit search. So I have 107 different results that match my criteria. Let's look at this one. Let's look at the CIBC card and Desjardins. Then I'm going to compare 2 or 3 results, and now this shows me side by side the features of these different cards to help me compare. So I've got the links to the different websites for them. It tells me the name of the bank or credit union, if there's an annual fee on them. All of these have no fee. And then it can tell me the interest rate. Purchase interest rate is 12.99 versus 19.75 versus 19.9. This tells me if there's a minimum income level required, and then the different rewards. Here, see how this one has a lower interest rate, but it doesn't have additional rewards, where these two have the higher interest, but they have cash back or they have groceries rewards. Here's how you redeem your rewards, any other benefits, and any insurance options that may come with it. So you can use this website to help jump through and compare all of the different credit cards available in Canada. Since it's from the Government of Canada, you know that it's a trusted third party who's collected all the information and it's entirely unbiased. Students can benefit often from many special offers from banks while you're in school. This includes the ability to open bank accounts, debit and credit cards without having monthly fees, things like that. It's recommended to find a credit card that fits your needs. It's important to shop around for different types of credit cards before selecting one. While a student card may have no fees, it's likely not going to come with any rewards or benefits either. So make sure that you're finding the one that works best for you. If you're going to be making a lot of payments using your debit card consistently, then potentially a student account may have a limit on how many transactions you can have, and then we'll start charging you per transaction after that. If you get 5 transactions a month, but you're using your card 15 times a month, then you may end up paying more in transaction fees than you would to have a more expensive bank account that has unlimited transactions. So make sure you find the one that works best for you, not just the one that they tell you is for you, right? If you're a student, you might feel like I have to get the student account. If it's not the right option for you, then find the one that is. So some other credit card types too that are available. First are prepaid credit cards. A prepaid card is a payment card that you can use to pay for purchases. Prepaid cards can be either physical or electronic. When you use the card, the merchant deducts the amount you use from the total amount on the card. So make sure you pay attention to various fees included when you have a prepaid credit card. Thing with prepaid cards is these do not improve your credit score. You are never actually borrowing money. You've paid for the card up front, and now you get a balance that you can take out of instead of borrowing money and then paying it off afterwards like debt. Now, a secured credit card requires that you provide a security deposit to the financial institution that issues the credit card. Your credit limit is normally set as a percentage that is equal to or higher than your deposit. Depending on the credit limit you request, the security deposit may range from a few hundred to a few $1,000s. If you don't make your payments, the financial institution may use your deposit to pay what you owe on the card. Be careful with signing up for a secured card from an unknown financial institution because you need to make that deposit. So make sure that they have the CDIC protection and that financial institution is secured. Now, with a secured credit card, this does improve your credit score because you are putting money into an account as collateral and getting a regular credit card using that collateral. So you're still borrowing, you're still using a credit card like a credit card, where a prepaid card is more like a gift card, where you've paid up front and then you take out of the balance. So let's look at another thing here. So this is the long-term pain that you can experience from making only the minimum payment. So say you owe $2,000 at 20% interest. If you were to focus on making the minimum payment in this case is 3% of your outstanding loan, or $10 per month, whichever is higher. So we would start by paying $60, and then as our balance goes down, the amount that we would have to pay each month would go down with it, because it's only 3% of the outstanding balance. Then we'd make our way down, we'd keep making payments, we'd keep making payments, we'd keep making payments, we'd keep making payments, we'd keep making them. Once they hit $10 being higher than the 3%, then we'd keep making those $10 payments, keep going, and there we have it. It would have taken us 15.25 years to pay off our $2,000 credit card, and we would have paid $2,240.60 in interest alone. So of the $4,240 we would have paid back, 53% of that would be interest payments. That's just money that we were charged for borrowing the money. So all we borrowed was $2,000, and we've ended up having to pay over $4,000 back. And it's taken us over 15 years. It's important to remember that at no point during this 15-year period did you ever use the credit card again. So minimum payments are not there to help get you out of debt. They are there to maximize the returns for the credit card company. Next, if you were to instead pay $100 a month consistently, instead of paying that minimum payment, it would take you, look at that, two years and just under $500 in interest throughout that 2 years. So almost $2,500 paid, 18% interest instead of 53%. But what if you don't have the $100 to make a $100 payment? Well, in this third scenario, we've maintained the $60 payment instead of decreasing it and only maintaining the minimum payment. So at the beginning for this first scenario, we had to pay $60 a month. So what if we just never dropped it? What if we kept it at 60? Well, it's not 2 years, but it's far away from 15 years. We're just over 4 years, just under $1,000 in interest. We can see the more you can afford to pay, the more benefit you will see from it. So if all you pay is the minimum, it's going to maximize the interest that you pay and maximize the pain. If you can pay anything more than the minimum, it's going to help significantly. So credit card fraud. This is something you need to make sure that you watch out for. If someone steals your credit card, they may be able to run up a large amount of purchases very quickly. Typically, your bank won't make you liable for charges from someone stealing your credit card, but it's best to be careful as the theft of your credit card can lead to identity theft, which can be much, much worse and much harder to try and recover from. Some scams use your stolen credit card to make purchases. Some scams use your card to steal your identity and open more credit under your name. Review your credit card statements to make sure that all the purchases are yours. Most bank-issued credit cards will not make you pay for unauthorized or fraudulent transactions on your card, but you will have to sign a statement claiming the activity was fraudulent and unauthorized. So tips when using your credit card in public places or at places of business. First, keep your credit card in a safe place. Keep it in your wallet. Keep it in your purse. Keep it somewhere on your body rather than having it loose in your pocket. Don't just carry around a loose credit card because that's really easy for it to fall somewhere and get lost. A wallet is larger. It's easier to keep track of. If it's in your purse, keep your purse on you. Don't set it down and walk away. Limit the number of credit cards you carry with you at a time. The more cards you have, the easier it is to lose track of those cards. Cover the keypad with your hand or body when entering your PIN so no one can see it. Right? You want to make sure that when you're putting your PIN into the machine, people aren't watching you. If they can watch you put your PIN number in, they now have one of two pieces of information they need in order to get your card and use it effectively. Keep your credit card in sight at all times when making a purchase. Don't go to the grocery store, put your card in, punch your PIN in, walk over and start loading your groceries. Come back, take your card out. Don't leave your card alone. Stand there, wait till it's done, take it out, put it back in your wallet. Same thing when you're in the drive-thru. When you use your card, put it back into your wallet, back into your purse before driving away. The person behind you might get a little bit annoyed, but you don't want to just throw your card loose into the dash or on the seat beside you and then lose it. And report anything that you think is suspicious about a credit card device at a business or ATM to the business's head office and your credit card issuer. If it looks like a machine might be broken, let somebody know, because if someone broke into that machine, they may put a scanning system into it so they can read your card rather than it going to the place it's supposed to. So that is section 2. So we looked at some of the different features of credit cards. You want to make sure that you understand how all of those different features work, especially interest and grace periods, so that you're paying your card on time in full. You can use the Government of Canada resource, which will be in the resource document, to help identify the right credit card for you. And paying more than the minimum monthly amount, even if it's only maintaining that higher payment rather than dropping it to the minimum, can make a big difference in terms of how much it costs you long term. Now, finally, let's look at credit scores and reports. So a quick video now about credit scores.
You asked, how does a credit score work? So I'll explain the basics in the time it takes me to make popcorn. A credit score is just a number, but like a bowl of popcorn, the bigger, the better. Bigger? I'll put more kernels in. The better the score, the less risky it is to lenders. The number ranges from 300 to 900, but a score of 750 and up is good. There's more to it than that, though. Your report takes into consideration your score and other information when determining how much of a risk you are to lenders.
Someone's writing a report about us?
By report, I mean a document that keeps track of your credit history and relevant personal information. Banks, phone companies, and insurers use this report to determine whether you can make a payment or not. There are many different factors that affect your credit score. For example, how many credit requests you make, your payment history, and whether you pay your bills on time. In fact, paying your bills regularly and before the end of the month is a very good practice to adopt. Now, let's say I have a credit card, and the only purchases I've made are Week of the Zombie, Month of the Zombie, and Lunar Month of the Zombie. To pay off the $60 they cost me, I'll make 2 payments of $20 this month and 1 payment next month, because making the minimum payment on time is crucial. Here's a spooky myth. Requesting a credit report will affect your credit score.
False.
You can get your credit report at any time without worrying about your credit score. It's a win-win. What did you win? A popcorn machine.
Okay. So, as a quick follow-up to that, what is a credit score? A credit score is a numerical summary of who you are as a borrower. So the higher your credit score, the more likely a lender is to give you money or give you a good interest rate when you ask for borrowing. So in general, a credit score in Canada, between 300 and 900 is the range. The video mentioned 750 and up being great. Equifax, one of the lead credit bureaus in Canada, has said anything over 660 and you'll likely be approved for general loans. But the higher your score, the better, because that higher score can get you better interest rates. It can get you more leverage for increasing what you are eligible for, things like that. So here's a general breakdown of what goes into your credit score. So roughly 35% of your score is your payment history. So do you make your payments on time? Do you make your payments in full? Do you make them consistently every single month? If you miss a couple of payments, that hurts your score, right? Your score is about consistency. 15% of it is the length of your credit history. So how long have you been making payments for? This, unfortunately, is something that you can't do too much about. It's kind of just be patient. It'll improve. But it means that there is benefit to opening credit earlier to give yourself time to build up that credit history length. Now, a long history of bad payments isn't beneficial. You want a long history of consistent good payments. Credit isn't something that happens overnight. It's something that happens with dedicated, consistent usage, proper usage. Now, 30% amounts owed. This is what we talk about as credit utilization. So how much of your outstanding balance, or how much of your balance is currently outstanding at any given time. So if you have a $1,000 limit, you want to keep 30% or less outstanding at any given time in order to improve your score. So if you have a $1,000 limit, that means on average $300 or less owing on the card to improve your score. If you have to use all of your limit, you can use all your limit. If you have to go above 300, you can go above 300. But try to keep it below that point on average to see benefits. If you're keeping about a 50% utilization, it's not going to cause problems, but you're not going to get any benefit out of it. If you start to have an 80, 90, 100% utilization, it may weaken your score. So trying to keep that 30% or less will improve your credit score. So now some other tips to help improve your credit score. Pay all your bills on time. Your payment history is the single most important factor to improving your credit score. In addition to mortgages, credit cards, and other loan and credit products, your payment history may also include certain accounts like phone bills, utility bills, even your rent. Late or missed payments can lower your score. Keep your balances low. Your credit utilization ratio is the amount of available credit that you're using at a given time. So as I mentioned, you want to keep 30 to 35% utilization if possible. If you're looking at a high credit utilization, that may end up lowering your score. Have a longer credit history. So again, this isn't something that just happens overnight. Improving your credit score takes time. It takes 6 months, a year and a half, but you will see improvement in your score if you keep up the good practices. Avoid unnecessary credit applications. Every time you apply for credit, this is called a hard check, and this decreases your credit score. So usually it's about a 6-point hit. So it's not the end of the world out of 900, but if you do this consistently, if you apply when you don't actually need it, if you take out a bunch of different credit cards, this is going to hurt your score over time. Have a mix of credit types. So having different types of credit can help improve your credit score. So that means don't just have a credit card. If you have other ways of using credit, this will improve your score. That doesn't mean you need to take it out just for the sake of it, but as you start to introduce different types of credit to your portfolio, then you will start to see a benefit if you are using all of them appropriately. So that can be things like a line of credit versus a credit card, an installment style loan like a car loan or a mortgage or student loans. All of these can help improve your score. And finally, get a secured card. If you're in a situation where you cannot, you don't have a strong enough credit score to be approved for a credit card, a secured credit card can be a great way to get access to credit to help you improve your score, to help get you back on track. So your credit score is based on what is in your credit report. Your credit report is a record of how you manage your credit obligations. It contains information on loans for the last 6 years, payment regularity, how much you owe per account, what your limits are per account, a list of authorized lenders who have accessed your file. There are 2 credit reporting agencies in Canada. You can get a free copy of your report from TransUnion and from Equifax, each once per year. It's your responsibility to correct any errors on your credit report. So I encourage you to request a free report from one of these agencies every year to make sure that things are on track. If you have good credit, it will give you more leverage in negotiating with creditors. So credit is a very powerful tool if you use it appropriately. There are lots of opportunities to spend small amounts of money on your credit card. If you are gaming, there may be offers to buy things for 99 cents at a time. It's easy enough to do these, especially if you have a credit card on file, but be careful that you all of a sudden aren't spending $25 to $50 a month on those little things. These are what we call micro purchases. Another potential example is various streaming services. Often there is a teaser rate, and they say a cost of $5 to $10 a month. And even 10 to 15 after the teaser rate might not feel like much, but if you end up having half a dozen or more services in very quick succession, you could be taking off significant amounts of money each month that will really add up over time, especially if you look at 1 year, 2 years, 3 years. So make sure if you're in a situation where you are making these purchases and paying for these different streaming services, that you don't just ignore them and pretend that they're not there, right? Pay attention, make sure that you're not being charged for something that you're not using. Next, buy now, pay later. So the concept of buy now, pay later has been around for decades. It started as layaway plans to allow buying a couch and then you pay for it in a year. The new approach to buy now, pay later could be a scary development for personal finances as it's become easier and it's a lot more prevalent. It's available for everybody all the time. You're able to buy a lot of things now, take them home, and then pay in 4 easy installments. The challenge is making sure that you truly can pay for all the things that you put on a buy now, pay later, as there are some new approaches. So you can use them on those smaller purchases. It can feel really easy to get a bunch of stuff and not have to worry about the prices until later. But if you don't have the money now, will you have the money later? So there are a lot of studies to show, and the reason that the way that they pitch it to merchants is 25% more sales, 30% higher value sales, and a 20% increase in repeat customers. As a customer, that sounds to me like they expect me to pay or spend 25% more, or buy things 20%, 25% more often, spend 30% more every time I buy, and come back 20% more often. So those things don't sound beneficial to me. So as a customer, I want to make sure that I'm cautious of these types of plans. And now a rent to own plan is typically an agreement for the rental of an item. So you'll not own the item until you've met the conditions in your rent to own agreement. In addition to your monthly payment, you may have to pay fees. These can include an additional amount to pay if you want to purchase the item. If you change your mind or if you don't want to buy the item, you can return it to the company. Some rent-to-own companies offer an option called same as cash. With this option, you don't pay additional fees if you pay the full amount within a set amount of days. Typically, you have to pay the full amount within 90 or 120 days of your purchase. So this table can give us an approximation of the costs for rent-to-own. You can see if we were at a retail store, it would be $800. If we did the same as cash approach, you don't have to pay it until 90 or 120 days down the road, but you end up paying significantly more than if you actually bought it through a different location. And then the rent to own approach, you get a whole bunch of additional fees in there. And yes, you pay it off over a much longer period of time, but it costs you a lot more money than if you purchased it up front. Now, the last thing we're going to look at here are payday lenders. So payday loans are very short-term loans where you essentially, I need money this week. I get paid on Friday, but my rent's due on Tuesday. So I get a payday loan. It's good that kind of resource is available if you need money like that. But in every circumstance, if you can get money in a different way, it will be better for you because payday loans are extremely expensive. So here is an example. So you borrow $300 from Money Mart for fixing the furnace at your house in February because it's February and your furnace broke and now it's -30 outside and you're extremely cold. If you repay the $300 in 2 weeks, you will end up paying back a total of $351. You had $51 in charges. That may not seem like a lot until you think about the annual interest rate that represents, right? That's a 2-week period being charged $51 on a $300 purchase. That is 442% annual interest in that 2-week period. If you had $100 in a savings account, paying 442% interest in 10 years, you would have $280 million. So if you had that same interest rate they're charging you, if you were able to get that, $100 in 10 years would be $280 million. So that is a lot of interest. Now, what if you didn't repay the $51 in interest plus the original in the 2 weeks that you had to pay the amount? You would end up getting a penalty of $40. So now you're actually paying, in general, an 800% interest rate. So this can really quickly get out of control. One of the big problems with payday loans is, as you can probably see, the $40 penalty is less than the $51 initial charges. So for some people, if you didn't have the $300 whenever you initially took out the loan, will you have it when you have to repay it? Because if you don't, it may be cheaper for you, or it may feel like it's cheaper for you to take the $40 penalty over paying the $51 in extra charges in order to keep the money out. And then every single time this happens, your penalties, your charges get even higher, and it can just get incredibly out of control. So you want to be really careful with payday loans. So here are takeaways from section 3. We looked at a credit score and why credit scores are important, because they can really help us get access to those larger ticket items that we wouldn't be able to reasonably save up for, like a house. You can improve your credit score by getting a credit card and using it responsibly. And you can get your free credit report annually to make sure everything on it is up to snuff. So that is everything for the workshop. We're going to do a quick summary. So in the first section, we talked about the different types of debt that are available. Debt can be a good thing if you are using it to benefit yourself rather than using it on those consumer expenses where it's, by the time you're paying for it, it's already gone. And we can look at using the snowball or avalanche method to help lower outstanding debt. Now, in our second section, we looked at credit cards, how we can select a credit card using that government tool to help find the card that works best for us, and make sure we pay more than the minimum payment on our cards. Otherwise, it's going to really hurt us long term. And we just looked at credit scores and reports. So our learning objectives, we wanted to understand how credit cards work. We wanted to be confident in our ability to and understand the value of paying off our credit card balance each month. And that's so we're not getting charged all that interest. And we wanted to have some steps to improve our credit score. So next steps, look into student accounts at banks and find a credit card that works best for you. Request a free credit report so that you can keep track of what your credit report is looking like and what's going into your credit score, and make a plan to pay off your credit card in full each month if you have a credit card or if you are starting a credit card. Okay, that is everything for the workshop itself. We're going to go into the Q&A now. So if you have any questions, please feel free. You can unmute, raise your hand, or throw something in the chat. And I'm going to put the link to the post survey into the chat. So if you complete the pre and post survey for this workshop, you'll be entered into a draw to win one of 4 $50 Tim Hortons gift cards. I'll give it a couple minutes in case there are any questions. It doesn't seem like we have any questions, so thank you very much for joining the workshop today. I hope you have a great rest of your evening, a great weekend ahead. Yeah, thank you very much.
Thanks, Chad.